Have you ever wondered why some economies, like Brazil's, just seem to hit a wall? I mean, it's a country with massive potential, but it feels like it's caught in this endless loop of low investment and sluggish growth. It's a real economic mystery, one that's had experts scratching their heads for decades. So, what's really going on here? Let's dig in.
To really get a handle on this, there's this fantastic metaphor that economists use. So for a second, forget about the spreadsheets and the economic models, and just picture this: a dolphin leaping out of the water.
Yeah, they actually call these dolphin countries. These are economies that make a spectacular leap, a big burst of growth, and for a moment they hang there in the air, looking like they're about to fly. But then, they always fall back into the water. It's this cycle that you see a lot in Latin America, where economies often feel like they're just bobbing along, totally at the mercy of these huge, volatile global market waves.
And that right there, that's the dolphin paradox. Why the leap, but never sustained flight? What invisible current is always pulling these economies back under? You know, to figure that out, we have to look way past the obvious explanations.
All right, so if you corner an economist and ask them about this problem, they're probably going to point to a couple of the usual suspects. These are the go-to standard explanations you hear all the time.
So on one hand, you have fiscal populism. This is the idea that the government is just spending way too much money, running up huge deficits, and basically sucking all the oxygen out of the room, so private companies can't get loans to invest. Then, on the other hand, you have exchange rate populism. This theory says the country's currency is kept artificially strong, which sounds good, but it makes foreign goods super cheap. And that just crushes local industries who can't compete. Now look, both of these are definitely part of the picture, but they don't tell the whole story, not even close.
To really crack this case, you got to do what they always say in the movies: follow the money. The real key here isn't just about how much money a country has, but who has it, and, way more importantly, what are they actually doing with it?
And that leads us to a really critical question. When the wealthiest people in a country, like Brazil, get their income, how much of that money is actually getting plowed back into building new factories, developing new technology, and starting businesses? You know, the stuff that actually creates jobs and drives long-term growth.
And this is where things get really fascinating. This chart reveals a huge disconnect. The super rich, the top 1%, look at that. They're investing a massive 60 to 80% of their income. But then you look at the rest of that top 10%, the group right below them, and bam, the investment rate just plummets. It's less than half that. This is our first major clue. A huge slice of the country's elite just isn't putting their capital to work in a productive way.
And you might be thinking, okay, maybe that's just a Brazil thing. But nope, look at this chart. On the left, you've got Latin America, and you see that same pattern of pretty low investment from the top earners. But then look to the right, at developing Asia. It's a completely different universe. The investment rates are through the roof. This tells us we're not just looking at one country's problem, we're looking at a deep-seated regional issue. So this is where we get to the absolute core of the mystery. This isn't about individuals making bad choices. It's about the entire system. It's like they're caught in something called an extractive system trap.
In that trap, it often starts with something that sounds like it should be a good thing, but it's not. It's the resource curse. It's this bizarre paradox where having tons of natural wealth, like oil or gas or minerals, can actually end up making a country poor in the long run because it chokes off every other part of the economy.
See, all that easy-to-grab wealth, it encourages a certain kind of system to grow. Economists call them extractive institutions. And really, that's just a fancy way of saying the whole game is rigged. The rules are set up not to help everyone create new wealth, but to make it super easy to just funnel the existing wealth into the pockets of a small, powerful group of insiders. And if you don't believe me, the proof is right here in the numbers. Just look at these profit rates. In mineral extraction, profits were just soaring. We're talking 90, even 130%. But meanwhile, in actual industry, profits were struggling just to get past 15%. I mean, let's be real. If you could more than double your money just by digging something out of the ground, why on earth would you go through the risk and the headache of trying to build a factory?
And this, of course, leads to a behavior they call rent-seeking. It's not about people being lazy or uncreative. It's about people making the most logical, profitable choice in a system that's set up this way. It becomes so much more profitable to focus all your energy on grabbing a bigger piece of the existing pie instead of trying to bake a new, bigger pie for everyone.
And look, this isn't some new idea. The economist Michał Kalecki pointed this out ages ago. The bottom line is this: When your society is dominated by people who can get rich just by collecting these rents, it actively poisons the well for the real, productive investment that you need for long-term growth. The easy money kills the incentive to build anything real.
Okay, so if the whole system is a trap, how on earth do you get out? Well, it means you have to totally rethink what development even is. It's not about finding one magic policy to fix everything. It's about starting a journey of self-discovery as a country.
There is this brilliant economist, Albert O. Hirschman, who put it perfectly. He said, true development isn't about just optimally managing the resources you already know you have. It's about the messy, unpredictable process of finding and waking up all the potential and all the abilities that are hidden and scattered and unused all across your society.
So let's just toss out that dolphin metaphor for a second. Instead of those dramatic leaps and falls, let's think about a different animal, the ant. Think about steady, patient, collaborative, constructive work. It's about building something piece by piece together.
So what's this ant model of development all about? Well, think of every entrepreneur as one of these ants, going out into the dark to find a new path. They're taking all the risk. If their idea fails, if they hit a dead end, they bear that cost all by themselves. But if they succeed, they've just lit up a new path for everyone else. That discovery that, hey, you can actually make this thing profitably here becomes public knowledge. Others can now follow, imitate, and improve upon it. So the risk is private, but the rewards are social. The value created for the whole society is way, way bigger than the profit that first ant ever made.
And maybe that's the real answer here. As the great Brazilian economist Celso Furtado once said, development isn't just a number on a spreadsheet. It happens when we turn our creativity towards discovering what we're truly capable of. So the question for Brazil and for all the other dolphin countries isn't just about how to raise investment rates. It's about how to build a system that finally unleashes all of that hidden human potential.